Right now, at this exact moment, the same ounce of silver is selling at two completely different prices on two different sides of the planet. And the gap between those two prices just hit 60%. Let that land for a second. The COMEX screen in New York says silver is worth $108. A physical dealer in Dubai is charging $173 for the exact same ounce. A buyer in Tokyo is paying $161. A trader in Shanghai is handing over $152. The screen says one thing. The vault says something different. And the gap did not close. It widened. If you're watching this because you saw silver drop this week and you're wondering what is happening, stay right here. Because the price drop is not the story. The price drop is the distraction. The real story is in the spread. And when you understand what that spread is telling you, the price action makes complete sense. Welcome to the hidden economy. I expose what the financial media will not cover because the financial media is funded by the same institutions that benefit from your confusion. Subscribe right now because what I'm about to walk you through is the kind of analysis that gets buried. And by the end of this video, you'll understand exactly why. Let's start with a single number that broke my brain when I first saw it. That is the number of paper claims that currently exist for every single registered ounce of silver inside COMEX vaults. Not 10 to 1, not 50 to 1. 356 paper ounces for every 1 ounce of real metal available for delivery. Think about what that number actually means. If even one in every 356 traders simultaneously decided they wanted their silver in physical form, actual bars, not a number on a screen, the entire COMEX delivery system would collapse before noon. That number does not exist in a fair market. It cannot. It is a structural impossibility that has been allowed to persist because, for decades, almost nobody asked for physical delivery. They were happy with the paper. They trusted the system. They believed the screen price was real. But something changed, and the 60% premium is the proof. Let me show you how this happened, step by step, because once you understand the architecture, you'll never look at a silver price chart the same way again. Here is the most basic fact about the silver market that most retail investors never learn. There are two silver markets. They are supposed to be the same market. They are not. The first market is the paper market. This is COMEX. This is where futures contracts trade. This is where banks, hedge funds, and algorithmic traders move billions of dollars of digital silver every single day. Most of this silver does not exist. It is a ledger entry, a promise, a number in a database. When you hear the silver price, you are hearing the paper price. The price of a promise, not the price of the metal. The second market is the physical market. This is where you walk in, hand over currency, and walk out with real metal you can hold. Coins, bars, rounds. Weight you can feel. This market has its own price, and right now that price has completely decoupled from the paper price. Here's what should immediately concern you. The premium held through the entire dump. When silver fell from $121 to $95 in late January, the physical premium did not compress. It expanded. Dealers didn't lower their physical prices to match the falling paper price. They raised them. That is the tell. That is the signal. A falling paper price that causes rising physical premiums is not a normal market. It is a broken one. But that's not the part that should concern you most. The part that should concern you is that this breakdown has been building for 5 straight years, and in the last 90 days, it accelerated beyond anything the paper market architects anticipated. Let me show you the data. 5 consecutive years? That is how long global silver demand has exceeded global silver supply. Every single year since 2021, the world has consumed more silver than it mined. The cumulative deficit across those 5 years sits at over 800 million ounces. Think of it this way. The mining industry has a 100-meter head start in a race, and demand is running 110 meters every lap. The gap compounds. The buffer shrinks, and eventually there is no buffer left. COMEX registered silver, the metal actually available for delivery, stood at roughly 32 million ounces as of last week. Total paper obligations against that silver? Over 4 billion ounces. Read that again. 4 billion in paper obligations. 32 million in real metal. That ratio, 356 to 1, is not a rounding error. It is a time bomb, and the clock is ticking faster than most people realize. Let me connect some dots that the mainstream financial media refuses to connect. Because individually, each data point looks like a coincidence. Together, they form a pattern, and patterns this consistent are never coincidences. Start with JPMorgan. In 2020, JPMorgan paid $920 million, the largest fine in the history of precious metals markets, after the Department of Justice found that their traders had spent years spoofing the silver and gold markets. Spoofing means placing massive fake orders to move the price, then canceling those orders before they could be filled. They were manipulating the price of silver for profit. They admitted it. They paid the fine. And then they kept their silver. Here is the accumulation timeline that nobody in mainstream finance wants to talk about. In 2012, JPMorgan's physical silver holdings were estimated at less than 5 million ounces. By 2015, that number had grown to 50 million. By 2019, 150 million. By 2024, estimates put their holdings at 500 million ounces. And as of January 2026, reports citing warehouse receipts and delivery data put that number at approximately 750 million ounces. 750 million ounces. Let me give you a reference point. The entire COMEX exchange has 32 million ounces available for delivery. JPMorgan holds 23 times more silver than the entire delivery inventory of the most important futures exchange on the planet. But here's what changed everything. Between June and October of 2025, JPMorgan quietly closed their entire short position. For the first time in modern history, the bank that spent 15 years suppressing the silver price is now positioned exclusively long. They stopped betting against silver. They are now betting everything on silver going up. Wall Street is not confused. They know exactly what this means. The question you have to ask yourself is, why would the most informed trading desk on the planet, a desk with government connections, insider data flows, and 15 years of accumulated metal, why would they flip their entire position at this exact moment? They did not flip because they think silver might go up. They flipped because they know something is about to break. And then something strange happened to the vault numbers. On January 7th, 2026, COMEX reported deliveries for the day. JPMorgan delivered 1 million ounces of silver. The combined total from every other entity on the exchange, approximately 81,000 ounces. JPMorgan provided 99% of all silver deliveries on that single day. Not 60%, not 80%, 99%. The implication is stark and simple. Almost nobody else on that exchange has any physical silver left to deliver. Now layer this with what is happening on the other side of the world. On January 1st, 2026, China implemented sweeping new export controls on silver. They classified silver as a strategic national security material, the same category as rare earth elements used in weapon systems and advanced semiconductors. Under the new rules, only 44 state-approved companies can export silver from China, and each export requires direct government authorization. Here is why this matters more than almost any other piece of information in this video. China refines 65 to 70% of all silver produced globally. They are not a participant in the silver market. They are the choke point, and they just partially closed the valve. Before January 1st, China exported over 4,000 metric tons of silver annually to the rest of the world. That flow is now restricted. The rest of the world, Europe, North America, Japan, the Middle East, has to source silver from somewhere else. And the somewhere else is increasingly empty. Once you understand the ratio, the price action makes sense. The paper price falling while the physical premium explodes is not a contradiction. It is the system working exactly as designed for the people who built the system. The paper price falls. Retail investors panic. They sell their physical metal at a discount. Informed buyers, the ones in Dubai, in Shanghai, in the private vaults of sovereign wealth funds, absorb every ounce. The paper price is the tool they use to harvest the metal from people who don't understand the mechanism. This is not the first time this has happened. The pattern is older than most people watching this video. In 1979 and 1980, the paper and physical silver markets went through a similar, though smaller scale, divergence. Physical silver could not be sourced at the paper price. Dealers ran out of inventory. Premiums exploded. The paper price eventually had to catch up to physical reality, and when it did, silver went from $6 to $50 in months. An 800% move in less than a year. In 2011, the same playbook appeared again. Paper price suppression via coordinated margin hikes. CME raised margin requirements 5 times in 9 days during the May 2011 crash. Physical metal disappeared from dealer shelves even as the paper price fell. The premium held through the entire dump. Anyone who understood the pattern and held physical did not lose money. They were buying at a discount from panicking paper traders. Same playbook, different decade. But here is what is fundamentally different in 2026, and this is the part that has no historical precedent. In 1980, the industrial demand for silver was modest. In 2011, it was growing but manageable. In 2026, silver is not just a monetary metal. It is a critical industrial input for the fastest growing technology sectors in human history. Solar panels. Each panel requires silver paste for electrical conductivity, and there is no commercially viable substitute. Electric vehicles, every EV requires more silver than a conventional car. 5G infrastructure, every base station, every tower, every relay. And artificial intelligence, the data centers that power AI systems consume silver in their circuit boards and connections at a scale that didn't exist 3 years ago. Global annual silver demand now exceeds 2 billion ounces. Global annual mine production sits at approximately 835 million ounces. The industrial gap alone, before you count a single coin or bar purchased by a retail investor, is nearly 400 million ounces per year. That deficit is being funded by above-ground stockpiles that are now critically depleted. Here's what they filed at 3 a.m. that nobody is talking about. In late 2025, the US Mint quietly filed documentation pausing silver numismatic sales, not because of low demand, but because they could not source adequate silver blanks. The United States Mint, a federal government agency with procurement reach that no private entity can match, could not source enough silver to meet retail demand. Meanwhile, JPMorgan is sitting on 750 million ounces. The government is struggling for supply. The bank controls the supply. You do not need a conspiracy theory to understand the power dynamic in that sentence. The math tells the story. If you are still watching this and you have not subscribed yet, fix that right now. Hit the bell. Because when the next data drop comes out of the COMEX warehouse reports, you need to see that analysis before the mainstream narrative gets to you first. So where does this leave you? Let's talk about what actually happens when a 356.1 paper to physical ratio meets a physical market running on empty. Because it is not theoretical, it is already happening. You're watching it in real time. You just need to know where to look. The Perth Mint suspended wholesale silver orders in late January, before the crash, when silver was still at 117s. They cited overwhelming demand and a backlog they could not clear. This is one of the largest and most reputable mints on the planet, an institution backed by the Australian government, telling the global market, we do not have enough silver to fill our existing orders. Before the price dropped, before the panic buying started, then silver crashed to 95. What do you think happened to demand? It exploded. A 22% discount on an asset that sovereign mints cannot keep in stock does not reduce buyers. It creates a tsunami of new buyers. The Royal Mint in the UK sold out of silver bars. The US Mint repriced silver eagles 86% higher overnight. Indian dealers began defaulting on delivery commitments, taking payment, then failing to ship the metal because the metal wasn't there. Costco implemented purchase limits on silver bullion. Not a sale. Not a promotion. A ration. Costco is rationing silver. And in Shanghai, the SHFE vaults, the Shanghai Futures Exchange warehouses, recorded a single-day withdrawal of 26, 94 metric tons on January 30th. In one trading day, at that drain rate, those vaults hit zero in under 3 weeks. China has classified silver as a national security asset, restricted its exports, and is simultaneously draining its own exchange inventories at a rate that defies explanation unless you accept the obvious conclusion. They are removing silver from the publicly accessible system and moving it into private strategic reserve. The West is still pricing this like 2019. The East stopped pricing it like 2019 about 2 years ago. Now I want to talk directly to 3 types of people who are watching this right now. The first type is scared. You saw the crash. You are looking at your position down 20% and you want to sell. You are making an emotional decision based on a paper price that, as I have just shown you, does not represent the physical reality of the silver market. The premium held through the entire dump. If you sell your physical silver because the COMEX screen scared you, you are handing your metal to the people in Dubai who will gladly pay 60% above that screen price to take it off your hands. Don't be the exit liquidity. The second type is confused. The signals seem contradictory. Price falling, but mints closing. Paper says one thing, the vault says something different. I understand the confusion. That confusion is not an accident. It is engineered. The paper market exists in part to create exactly this cognitive dissonance, to make you question your own analysis, to make the obvious conclusion seem too extreme to act on. The third type understands. They see the 356.1 ratio and they understand what it means when that ratio starts collapsing. They see JPMorgan's long flip and they understand what it means when the most informed trading operation on the planet changes sides. They see the Shanghai vault drain and they understand what it means when the world's largest silver refining nation starts hoarding its own product. They are not paralyzed by the paper price. They are using it. Here's the practical reality. Which category of silver holder does this data matter most for? If you hold physical silver, coins, bars, anything with real weight, the paper crash is noise. Your metal is worth what someone will actually pay for it in the physical market. Right now in Dubai, that is $173 per ounce. In Japan, $161. Your physical silver is not worth $108. The COMEX screen does not determine the value of something it cannot produce. Paper says 108. The vault says something different. Trust the vault. If you hold paper silver, ETFs, futures, any instrument that promises you silver exposure without actual metal, ask yourself one question. If every holder of that instrument demanded physical delivery tomorrow, could the counterparty deliver? Based on the 356.1 ratio, the answer is structurally no. You do not own silver. You own a claim on silver that depends on most other claimants never asking for the actual thing. That is a bet on continued mass passivity. In a world where Shanghai is draining 27 tons a day, that bet is getting riskier by the hour. If you are on the sidelines waiting to buy, understand that physical premiums are not compressing. They are expanding. The paper price crash created more demand. More demand is reducing available inventory. Reduced inventory is widening the premium further. The paradox of this market is that the lower the paper price falls, the harder it becomes to buy real silver at a price anywhere near that paper level. This is not financial advice. Your money, your decisions. I'm not telling you what to do with your portfolio. I am showing you what the data says. Publicly available data from COMEX warehouse reports, SHFE delivery figures, mint announcements, CFTC filings, and bank positioning data. The information is public. The pattern is documented. What you do with it is your choice. But let me tell you what the data is pointing toward. The lease rate, what it costs to borrow physical silver temporarily, has gone from under 1% in normal conditions to reports of 8 to 39% in recent weeks. 39% annualized just to rent silver for a short period. That is not a tight market. That is a market screaming that physical silver is not available at any reasonable price. When lease rates spike like that, it means the arbitrage mechanism that is supposed to keep paper and physical prices aligned has completely broken down. The arbitrage should work like this. If physical silver in Dubai is 60% above COMEX, a trader should be able to buy silver futures on COMEX, take delivery, ship the metal to Dubai, sell at the higher price, and pocket the difference. Free money? That trade would compress the premium back toward zero. The fact that the premium is not compressing, that it is widening, tells you the trade is not executable. You cannot take delivery from COMEX in the quantities needed. The metal is not there. The arbitrage is broken because the underlying assumption that COMEX actually has silver to deliver is no longer reliable. Wall Street is not confused. They know exactly what this means. The 356.1 ratio is not a secret. The vault reports are public. The delivery data is filed. Every sophisticated trader who wants to understand the silver market can see the same numbers you are seeing right now. They are not acting on them because they are confused. They are acting on them because they have chosen which side of this trade to be on. JPMorgan chose 750 million ounces of physical silver, no leverage, fully long. China chose export restrictions, strategic reserve classification, vault drain. The Perth Mint, the US Mint, the Royal Mint, they told you what is happening on their shelves. Empty. The premium told you 60% above spot and holding. At some point, and I am not giving you a date because nobody can give you a date, the paper price has to reconcile with physical reality. Either the paper price rises to reflect what physical silver actually costs in the real world, or the physical market stops functioning entirely as a market and becomes purely an allocation system for strategic buyers. One of those outcomes is recoverable for retail investors who hold physical. The other is not. Before the end of this video, share it with one person who is watching their silver position and panicking right now. Not because it will help me and because it might help them. Most people will never see this analysis. The mainstream financial press will tell them the crash is normal, the market is functioning, nothing to see here, but you saw it. You understand what the 356-1 ratio means. Help someone else understand it too. Subscribe to The Hidden Economy. I am going to keep pulling these numbers, filing by filing, vault report by vault report, because this situation is developing faster than most people realize. The next COMEX inventory report drops in 8 days. If registered silver falls below 30 million ounces, we are in genuinely uncharted territory. I will be here breaking it down before anyone else. Drop a comment. Tell me, after seeing the 356.1 ratio, do you still trust the COMEX price as a real representation of silver's value? I read every single comment. Let me leave you with this. The paper price crashed. The whole world is paying 60% above that price to get real metal. The mints are closed. The vaults are draining. The lease rates are at 39%. JPMorgan flipped long for the first time in history. China locked down its exports. And 356 paper ounces exist for every 1 ounce of real silver available for delivery. One of these things is a fair market. And it is not the COMEX screen. Here's the question I cannot answer. And it is the one that matters most for everything I've shown you today. JPMorgan delivered 99% of all COMEX silver on January 7th. When they decide to stop delivering, when they decide the accumulation phase is over and the extraction phase begins, what happens to the 356 paper holders waiting behind them? The next COMEX warehouse report is due May 16th. I will have the breakdown the same day it drops.